Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, and we're going to try and help you sharpen some of your trading skills and learn about how to make more money in the stock market and take control of your investment success here. And this week we have a first-time guest, and she's phenomenal. As the lead writer for live markets coverage at the Wall Street Journal, she has a front row seat to the most significant market shifts happening today. She's covered everything from the meme stock mania that inspired a Netflix documentary, Eat the Rich. She's reported on the rise of zero-day options, leveraged products, volatility, and how the modern retail investor is reshaping market structure. So please join me in welcoming Gunjan Banerji. How are you doing, Gunjan?
Great. Thank you for having me, Justin. I'm excited for this.
Yeah, it's one of those things where, we got bought by Dow Jones here at IBD about 5 years ago almost. And it's like we've got all of these great reporters, the Wall Street Journal. I would love to have more of you on because there's just such insightful things that you guys are producing over there. I have so much respect for what you do. So it's really a pleasure to have you on. But let's get right into
Thank
it.
you.
I think
Yeah,
one of the biggest things, Gunjan, that I've learned from your reporting, and by the way, you're a favorite amongst some of my
thank you.
colleagues as well, is kind of how you're talking about this new generation of investor. And I started in the late '90s with my investing program, and it seemed like that was a new generation of investor, right, going online. But what do you think is kind of changing about this latest generation of investor?
There are more individual investors in the markets today than ever before. And many of them have more of their portfolios in the stock market than ever before. I think the average American is just more engaged and interested in the stock market than previously. And of course, that's come with the blurred lines that we've seen between trading and gambling and investing. But we've just seen so many Americans enter the markets, and a lot of them view trading as entertainment. A lot of them are investing for the long run.
Yeah, it's kind of a weird thing that happened. That entertainment factor. Certainly, Robinhood, with a little bit of gamification that came about, it did seem to kind of change the thing. And speaking of Robinhood, we had the chief brokerage officer on not too long ago, and I
Oh,
was very,
Steve, he's
yeah,
great.
Steve, yeah. So I
Yeah.
was very intrigued by the fact that now it's the prediction markets. So when you talk about gambling, I mean, I've been trying to convince my wife for years that the stock market is not gambling, but now with prediction markets and sports betting, well, now you can kind of do that from your brokerage account. Is that does that seem weird to you or odd?
Well, look, I think you can bet on sports on the same app that you can bet on what the Federal Reserve is going to do, and where Tesla and the S&P 500 are going to be anywhere from today to months and years from now. But I think this is the natural change that's occurred as a result of technology changes among brokerages
Hmm.
and just a cultural shift that I think has happened over the past few years. And I do want to say not everyone is gambling in the stock market, right? I
Yeah.
talk to hundreds and thousands of individual investors, and I'm always so blown away by how intelligent they are and how interested they are in the stock market and how much they know about the stuff that they hold. I sometimes I think like Wall Street does not give the retail investor enough credit.
No, well, that's certainly the case, and maybe to their detriment, because in the fight between Wall Street and Main Street, certainly one of the big reporting stories that you had was on the meme stocks like GameStop, and of course, that was a case in which the it seemed like the retail investors were using greed against the professionals and really kind of took them to the cleaners in a big way. Um, what do you think is kind of bringing that, I guess, more sophisticated level of investing to a select group of people? And is that social media side of things kind of giving them more mass and force behind some of those moves?
Yeah, I think social media is just a really key ingredient in the gambling and trading environment that we see today. I think one downside is that often individual investors do end up taking advice from social media influencers. They end
Hmm.
up following stocks and tickers that they've seen on Reddit or X, and some of those can work out really great, right? Like the Palantirs and the Teslas of the world, but some of them go bust.
Yeah.
But I do think that we're seeing that individual versus Wall Street dynamic at play again this year, where it feels like during every single moment of volatility that we've had in 2025, including around Liberation Day, many retail investors stepped in to buy while hedge funds were selling aggressively, betting against stocks. And I think that's led to some really big gains for retail investors this year.
Hmm. Well, to that point, there's a lot of, I mean, for as much as the Nasdaq has been up, I would say that there's probably a lot of mutual funds and hedge funds that have struggled a little bit more. I
Definitely.
mean, in 2023, it was kind of the year of the FANG stock or the Magnificent Seven. It has been kind of a little bit different this year. Certainly, a lot of strength in those names, but a mixed bag with some stocks like Meta doing very poorly, whereas others like Alphabet have been doing very well. And it's kind of, I guess, this backdrop of AI and who some of these winners are going to be. So do you kind of see that shaping, I guess things in a different way, especially the concentration of market cap? I mean, it wasn't that long ago that it was like, oh, wow, we broke $1 trillion in market cap. And now it's
I
like,
know.
you know, now everybody's doing it.
Right, right. And, I think a lot of these big technology stocks, the Magnificent Seven stocks, they are some of the favorite trades among individual investors. It's funny, I was talking to someone at a hedge fund the other day, and they were saying, look, the market is up a lot this year, but it hasn't been an easy year for a lot of
Right.
hedge funds. There's been a lot of institutional investor underperformance. And, a lot of them might have to chase the market heading into the final weeks of the year.
Hmm. No, absolutely. And again, it's also kind of interesting because we've had these back-to-back very strong years in the market, and so there's maybe those people that, for as much as we've been going to new highs and really on a tear when you consider it, there does seem to be a lot of negative sentiment out there still about people just wondering about, is this an AI bubble? Is it going up too much too fast? And all of those. Have you been kind of getting a gauge of why there's been such negativity as we've been hitting new highs?
Well, I think this year has just confounded everyone, right? Think back to April when it's felt like every investor, every trader, every economist was really calling for a recession after President Trump's tariffs. And here we are, mid December, late December, as of this shooting. And we have not fallen into a recession. The economy has held up. Jobs market has held up too, though things are, of course, starting to take a turn a little bit. But I think similar to years past, that recession case simply has not shaped up. That
Mhm.
bear case has not come to fruition. And that's made it challenging, I think, for a lot of institutional investors. And it's made it a really challenging environment to make forecasts and predictions about where things are going to go.
Well, speaking of forecasts, and since you brought up the jobs data that has been coming out and the Fed and everything else, it seems like for the last few years, investors have really gotten it wrong in terms of what the Fed futures rate has said about when the market cutting cycle was going to start. How many? I mean, I think early on it was, oh, we're going to get 7 cuts in a year, and then it was like, oh no, we're not going to get any. So between the being so wrong on the Fed futures and being so wrong on the recession side, what? Yeah, I mean, you already said that the forecasting is really off right now. So should investors be looking at forecasting differently, or are the models broken? What do you think is happening?
I think people are looking at forecasting differently. I mean, just think about the prediction markets. Those
Hmm.
have burst into the forefront and they have become this brand new indicator that people are tracking all the time. In addition to jobs data, in addition to the financial markets, it's just become another thing that I think Wall Street investors and Main Street investors are checking quite frequently. Not to mention, we've had a particularly strange environment for forecasting with the government shutdown and the delayed
Hmm.
jobs report. We didn't have an unemployment rate out of the household survey that the Labor Department conducts for the first time in 80 years. So it's been strange times for forecasting and economic data.
Hmm. And then on the volatility side, certainly there. you kind of alluded to this, but it does seem like a lot of times there is a buy on the dip mentality
Yes.
that has been going on. And again, I started in the 90s where buy the dip was working great until it didn't. Right, with
Mhm.
stocks like Cisco and Yahoo, it worked great as Cisco went up to 82, but then when it went down to like single digits, that was a
Oh my
disaster.
god.
Right. So, what do
And
you
you invested through that?
no, 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 no. I was out in March. No,
Okay.
no, I did not hold through that.
Okay.
My problem, to be honest, was I kept on trying to get in, back in, going on margin, going too deep, and that's where I got my head handed to me. I
Wow.
got
So
out great.
you were trying to buy the dip.
I was looking at the strength, but I wasn't holding through the dip.
Okay.
It was going too quickly on some of those. And again, because the 90s was so fun, I just wanted to recapture that. And it's like, no, things are different now. It took me a while. And you got to remember that during that 2000 to 2002 time period, we had some very stunning rallies. After September 11th, there was a 40% rally in the NASDAQ. It just didn't last. And it was among a bunch of devastation, which again kind of reminded me a little bit of when the tariff action happened, or COVID, this very V shaped, we came down so hard, but then the volatility, we came up so much, so quickly. It was almost like you blink and you miss the correction. Or I guess if you had buried your head in the sand, that was actually maybe the best thing to do. But risk management wise, that's not normally, it works until it just fails disastrously. So, do you think that there's something changing here on the risk management side for folks?
I think appetite for risk in the markets has just never been stronger. I think we
Hmm.
are just in a new era when it comes to risk taking, risk management, appetite for risk. People are hungry to bet big on stocks, sports, options, prediction markets. It's unlike, anything I've ever seen during my time at the Wall Street Journal. I
Hmm.
certainly wasn't investing or covering the tech bubble or the global financial crisis, but I have followed the trajectory of individual investors since the meme stock mania. And I think levels of risk taking in some ways are above 2021 levels this year, just in terms of the sheer leverage that we're seeing in the markets. And, buy the dip, the strategy that you're saying you tried to use you know, in the 90s, early 2000s around the tech bubble, it's morphed into a viral stock market sensation. Like it's become this like larger than life rallying cry for many individual investors who staunchly believe that they should be buying on every single dip in the market.
Hmm. Right. But again, a lot of that is prefaced on that you have to be doing selling, right? You have to get that cash from somewhere. So you have to be, selling at some point. And I guess,
Or
and
keeping some cash on the sidelines,
right, or
right?
keeping some cash on the sidelines,
Yeah.
absolutely. And again, I wasn't really buying the same stocks on the dip. I was buying a whole host of new stocks. Whether it was defense ahead of the Iraq War or what have you. But one of the things now, and maybe not so much anymore, but for a while there were some very strange vocabulary being used, like diamond hands, hodl. It was almost like we don't care how much it goes down. In fact, one of the things that was the strangest to me was people bragging about how much money they were losing. Kind of this, almost like a badge of honor of how much money they were losing that they would post. So again, I guess that's where sometimes the risk management side seems a little weird to me, where there, there just doesn't seem to be a risk management plan. It's just kind of like, no, it'll come back eventually. It's going to the moon, and I don't want to lose my position, so I'll hold no matter what. Is that something you're still seeing?
We have seen the rise of the so-called degen trader the past few years. And, that word, it's unclear where it comes from, but some people say it comes from degenerate gambler and
Hmm.
kind of lionizing the big risks that gamblers take. So
Hmm.
yeah, there's a lot of crypto options, stock, leveraged ETP traders who pride themselves on being degen traders and, just walking into taking big risks and being able to withstand these like stomach churning moves.
Hmm. And why? I guess I guess that's the other question. Like why? Because
Yeah.
again, I look, I'm 50. I'm looking at this as retirement. I don't have the runway to mess around and just wait for hopefully
Hmm.
things to come back. And again, I take it as my retirement pretty seriously. Like why do you think that there's kind of this degen thing going on where it's like almost like a lack of seriousness. And I think that's where maybe sometimes the older generation is looking at the younger generation and like, you guys aren't treating this seriously, type thing. Where do you think that comes from?
I think there's been a cultural shift, right? Taking risks is lionized and it's been rewarded. Just think
Hmm.
about all these crypto millionaires out there, right? And it seems like they took big risks and kind of struck it rich overnight. So I think
Hmm.
a lot of people see the crypto millionaire next door. There's a lot of FOMO associated with that. You're only seeing the wins posted online. You're not really seeing, you know, the ugly drops.
Hmm.
So there's a lot of FOMO, and then I think, yeah, I think social media does fuel some of this.
Hmm. Well, and certainly we have to, because you mentioned how many new investors there are. And whereas the great financial crisis seemed to have cleaned out a lot of people, where they're like, oh, no, I'm not doing this anymore. I have no appetite for the market going down 57%
Yeah.
and for stocks that had been around for 100 years like Bear Stearns and Lehman Brothers just going belly up. So there was kind of this pendulum swing there. And then it seemed like with COVID, you had all of a sudden all these people at home kind of like, oh, well, what am I going to do uh, from home to make some money while I'm not, necessarily working? And all of a sudden you have this, rise of the investor. So do you think it's not until we get I mean, and look, 2022 was no walk in the park. That whole rate hike cycle certainly devastated, a lot of people in the market. It was just so long and prolonged, and especially with the small caps. But do you think we need almost like um, a crisis in order to get risk management back on like normal ground?
I always think of what Warren Buffett said at his last shareholder meeting, where I think he said something like, we haven't had a true hair curler event. Like, he doesn't think we've had really a true crisis era for the stock market in quite some time. He does not consider Liberation Day that
Hmm.
crisis era. However, a lot of people thought that higher interest rates in 2022 would quash some of this behavior. Um, it didn't, right? And in fact, this, it's just been rewarded to keep piling into the market and to keep buying on every single dip. I do think there's an element of this younger generation that's come into the stock market. They've largely known blue skies, right? To your
Yeah.
point, they have not seen the global financial crisis where it took years for stocks to bottom or recover. Stocks bottomed so quickly during COVID. 2022 was a bear market, but it
Mhm.
certainly did not feel like a global financial crisis.
Yeah, no, absolutely. It was not as
Yeah.
sharp. It was just more prolonged,
Yeah. Yeah,
which
so young investors have had it just really good, I think, the
mhm.
past few years. It's been a great time to be an investor.
Mhm. Another thing that you brought up again, just speaking of the tariffs and Liberation Day, I was either reading something of yours or watching you on something, and we tend to stay away from politics. We just care about, hey, how can we make money from the market? Who cares about the politics side? But you did bring up this whole red goggles, blue goggles thing, and how much do you think, especially with the polarization, that we've had in the political sphere, how much do you think that the politics, or whether you think Trump is right on stuff or whether you think he's wrong on stuff, is really, and it's important to have a thesis, but how much do you think it's clouding people's judgment in terms of how they are actually doing their investing?
I think it's clouding people's judgment, in terms of how they approach their portfolios more than we've seen in years. I was actually looking at some Gallup data that showed that how you viewed the president, how you viewed Republicans versus Democrats had a ripple effect into whether or not you were bullish or bearish on the stock market over the next year. So it's impacting the way people invest. And I saw that firsthand when I was interviewing people around, Liberation Day. where, people who had kind of soured on Trump or were not fans of his policies, they said they were maybe selling stocks, hedging exposure, which was really interesting. We have this political polarization that shows up in consumer sentiment data, shows up in voting data, of course, is now showing up in investment data.
Hmm. Yeah, no, that is very interesting. And since you bring up consumer sentiment, I guess, as you're looking at some of these numbers, one of the things that strikes me as a little odd, again, there's a lot of talk about the weakness of the consumer, but yet I'm looking at a lot of stocks in the retail area. A lot of data is coming out in terms of what people are spending, and there seems to be a disconnect. The consumer doesn't feel confident, but they're still spending, so where do you think that disconnect is coming from?
I know. I mean, I think it's really tough to say. It seems very vibes based sometimes, right?
Mhm.
In terms of how people are viewing prices and how people are viewing spending right now. But it seems like that's been the case for quite a few years now, where people are, balking at the price of eggs, balking at the price of vacations, but they can't stop booking that trip to the Caribbean.
Right. And are you seeing any data in the credit usage space that is maybe suggesting that there the sacrifices aren't happening, and again, there's maybe trouble down the way?
I think since what we are seeing is that since the COVID-19 pandemic in 2020, immediately after that, we saw some tremendous gains in wages among low income workers, right? And it
Mhm.
felt like people like servers and waitresses were seeing these giant wage gains, and it was helping close the gap a little bit. But now that's taken a big turn. We've seen wage gains cool, and at the same time, we're seeing inflation kind of eat into some of those wage gains.
Right.
And that's leading to what a lot of investors I've been chatting with keep pointing to this two-track economy that we're in terms of this divergence between the haves and the have-nots.
Hmm. Yeah, no, that is definitely one of the key things that folks are looking at. I want to also um, get a little bit back to the Fed and everything that's going on, because there's so many mantras, right? Don't fight the Fed. The
Yep.
Fed, what they do is so important. And with some of the shifts that are happening, Jerome Powell is, uh, you know, got limited time as the chairman. Um, where do you see kind of the action taking? I mean, the Russell 2000, the small cap index, has certainly seen a
Yep.
little bit more oomph lately, but it it often seems like it just as it's starting to get going, it stops. But where do you kind of look at, or in your reporting and who you're talking to, um, how do you see the Fed landscape?
One
Excuse
thing
me,
that
over the
really
last year?
confounds me, yeah, yeah, one thing that really confounds me is that people like our investors love rate cuts. They love talking about rate cuts. And it feels like rate cut hopes tend to invigorate these rallies in the stock market. Yet
Hmm.
the stock market has done just fine since 2022, despite higher interest rates, right?
Hmm.
Because our economy has been strong. So that's just one dynamic I'm really fixated on right now.
Hmm. Now, I also want to talk about, I mean, rates are, fairly stable and you don't get much volatility, but I want to also talk a little bit more about some of your reporting on all of these new products. I mean, you
Yeah.
have the zero DTE options, the leveraged, first it was leveraged on indexes, then it's leveraged on single stocks. I'm amazed at how quickly some of those come out now. Um, Again, there just seems to be all of these ways to kind of put more money at risk, and, very quickly. Um, what do you see in that landscape in terms of the potential pitfalls?
So I recently wrote about perpetual futures, which is this crypto product where you can take 10x, 20x, 50x leverage on cryptocurrencies, right? So you put down
Because the
$100.
cryptocurrencies aren't volatile enough. We need to just really,
Exactly, exactly. So you put down $100 and that lets you control, say, $1,000 or
Mhm.
$2,000 or $3,000 worth of cryptocurrency. So if your trade goes right, if you're bullish at the right time, it works out great. If you get, caught flat-footed, you could be on the hook for a lot of money. But that has become one of the most popular trades on the planet and just a wildly popular way to bet on Bitcoin. I think that crypto market is really key to keep an eye on because I think you might start to see those structural changes and the products that have cropped up in cryptocurrencies. I think you might see them crop up in the stock market, in indexes, because it's an easier way to make these leveraged bets on
Hmm.
stocks.
Hmm. Well, now, Gunjan, I know that you've dabbled with some poker. You've played some poker in your day, and doesn't that almost feel like going all in, like just way too often? So again, I guess I'm still struggling with the risk management side. When you get that leveraged, a small move down can really wipe you out. So if it
Definitely.
doesn't go in your direction, like almost immediately, you're like done with the trade. I don't know. I guess, is that something where, again, is there a crisis potentially looming with that kind of action?
There was. I mean, these leveraged crypto trades were at the center of a crypto market meltdown in recent months, where people loaded up on leverage on the way up, and when crypto prices started falling, it those trades helped exacerbate the unwind, is what a lot of people were saying. So we certainly saw a mini crisis or a mini bout of volatility, and these leveraged products were at the very center of that.
Hmm. And it again kind of just strikes me as a little bit of the mania, whether it's the meme mania or, there's a lot of this get rich quick theme. It seems like in some of your reporting where that's what that's what people want. They don't want the get rich slow, which again, back to your Warren Buffett reference. That's his kind of thing, right?
Yeah.
If it's not get rich quick, it's how did he get so rich? Time. He survived. And that's sometimes that chip in a chair mentality for poker is also there. So I guess what do you think that investors need to look at more in terms of the survival part of it, being able to continue investing and having these maybe incremental moves, not as exciting, but allow that compounding over time, as opposed to just, "Well, let me make it all this year so I can retire at 20."
Yeah. Look, I think if people wanna gamble, great, there's nothing wrong with gambling. I enjoy gambling. I think
Hmm.
it's important to know when you're gambling and when you're investing, and one of the best pieces of advice I've heard out there is to keep a cowboy account, right? Keep
Mm.
money in a portfolio that you are comfortable gambling with and losing, and keep that separate from your retirement account or your long-term portfolio. Just be really honest with yourself about whether you're gambling or you're investing. I will say I write a lot about people trying to get rich quick and the proliferation of casino-like products in financial markets over the past few years. But there's so many individual investors out there who have gotten rich by staying in the market for decades and decades and decades. And I recently wrote about these 401k millionaires in a piece for
Hmm.
the Wall Street Journal, where there are more of these 401k millionaires out there than ever before. Many of them are Gen Xers, many of them are baby boomers, but they have just invested in index funds or long-term stocks and held that portfolio over time and basically never touched it. And that's how they've become millionaires. So I think that cohort of buy and hold investors is also out there, and they're very strong.
Hmm. Well, and it's interesting that you mentioned that, because it does feel like many of those investors did rely on the index funds, almost like, oh, you know what? I'm not smart enough to do this. I'm just going to let someone else do it for me. And whether it was through an index fund or through mutual funds, and again, it rewarded them over time. It was no get rich quick, but over time, it has rewarded them. So. I mean, of course, the term millionaire is not as exciting as it used to be because
People
of
keep
inflation.
saying that. I still think it's cool. You're a
Yeah.
401k millionaire. Congratulations. Like, I
Yeah,
think
I
you've
mean,
done
it's a
something
big
right.
thing. It certainly
Yeah,
is a
it
big thing,
is.
and maybe it's, maybe it's a different a difference in age thing, because again, as you get closer to retirement, you're like, oh, million's not going to do it. So
But I mean, there more than half of Americans cannot afford their retirements. If you have a 401k with $1 million in it, huge congrats. I think like people keep scoffing at the moderate millionaires, but I think it's time to celebrate these moderate millionaires and celebrate the money that they've stashed away, because I think it's pretty incredible.
yeah, I mean, I think it's definitely worth a toast, especially when you consider that, a lot of times that achievement is with very small contributions, right? There's limits on how much you can contribute, and even more limits on what your budget will allow you to contribute. So yeah, I definitely don't want to, detract from the fact that that is an absolute phenomenal accomplishment. I guess I was just thinking back. I think I shared this with you back in the game of life when, millionaire meant tycoon, like, you had it made. And millionaire now seems like, oh, it's you're on the right track. That's a good first step. um
Yeah.
but
But I don't know, it's interesting because I heard from a lot of readers after I wrote about the moderate millionaires, and many of them wrote in to say, "Hey, I'm part of the millionaire club."
yeah,
Many of them wrote to me saying they felt poor, saying exactly
yeah,
that. $1 million is not what it used to be. But again, I think we have to put it into context of like, what does the average American have saved for retirement? Can the
hmm,
average American afford retiring at 65 and 70? And many of them cannot. So kudos to you.
hmm, yeah, and yeah, I think again, it's a big milestone to accomplish. So again, on the one hand, we've got the 401k millionaires, and look, 401ks, by their nature, a lot of times don't have access to these leverage products. They don't have access to margin, all of these things that again kind of speaks to um, the get rich quick type mentality. It's kind of your more traditional buying. So I guess is there a contrast, do you think, here between the growth of the 401k millionaire and again this whole other side of folks that are like, I want my million now.
I think a lot of people do want their million now, and
Hmm,
are willing to risk a lot for it. Yes.
hmm, yeah. Um, just a few more things to kind of cover, and again, I've really been enjoying your take on so much. Um, so again, back to this 401k
Yeah.
millionaire. Again, they really, again, to some degree, um, gave up that control. They just kind of let someone else make
Yeah.
those decisions and put it in their hands. Um, I know that you are a very big fan of kind of taking away the curtain, or dropping the veil that of mystery on so much of investing. There's this, I think you referred to it before as an opaqueness that you would
Mm.
like to shed light on. So w- what do you think is kind of the next step for investors in terms of this balance of, hey, you can take more control and maybe allow a little bit more risk for yourself for some better returns, but at the same time, do something where you do get that benefit of the long term compounding results that so many of these 401k millionaires have seen.
Yeah, you mean like how do you decide how much risk to take on or how much of your own
Right. Well,
portfolio to control?
especially, because again, Gen Z, let's be honest, the financial literacy is something that I think our education system has faltered on for a very long time. And so how do these investors get good information? Because again, there is the, just let someone else take care of it, and then there's the um, go off of every tip, on social media. How do you think that people should go about getting themselves informed and knowing what information to kind of look at to get themselves more educated and bring down that veil of mystery on investing.
I would say be really careful of social media influencers
Hmm.
as they pertain to stocks, stock picks, trading in general. Those can be total minefields. And two, as with a lot of things, ask yourself how the person giving you advice is getting paid. And I think that's really, really crucial to ask yourself before you take advice or hand over your money to anyone.
Hmm. So you, as again the lead writer for the markets desk at Wall Street Journal, you probably have a ton of information, coming at you at all times. How do you do your sorting? How do you say, okay, this is what's important, these are the sources I need to look at, this is how I call all this noise, the fire hose of information, into something that is actionable, something that is reasonable, and something that makes sense. How do you make sense of it all?
Yeah, so I am constantly parsing so many things across my desk from bank research notes, analyst notes, tracking the markets myself via several different data sources, whether it's the stock market, bond market, options market. But I feel like the thing that helps me do that the best is like talking to my best sources who are really plugged into what's happening in the trading and investing world. And I find that's often the best filter for
Hmm.
what's going on.
Hmm. No, yeah. So I guess it's just a matter of really calling those sources, which I
Yeah,
know you've
yeah.
you've done very well. But everyone kind of has to, figure out who their sources are going to be. Whether it's the Wall Street Journal, Investors Business Daily, CNBC. And I should have mentioned that you are also a contributor, a frequent contributor on CNBC when I did your introduction.
Thank
So
you.
folks can definitely catch you on there. Um, and do you have anything in terms of things that you're working on for kind of that next step in financial education for folks?
In terms of financial education, no. But one thing I do want to bring up and tied to your interest in the whole 401k millionaire trend is that I think one thing that's really emerged as a big theme for me is like this loop that I think is stronger than it's been in the past between the stock market and the economy, right? Where rising share prices, because so many more Americans own stocks, household allocations to the stock market as a percentage of their total financial assets are really at a record. When people see their stock market portfolios going up, that can boost consumer sentiment, that can boost spending. So I think all these dynamics that we've been talking about, generational shifts with investing, risk tolerance, the buy the dip mentality, I think those factors actually trickle into the economy more than they did before. And I think that'll be really interesting to watch in 2026.
Any trends that you're particularly watching? I mean, I know everyone is talking about AI, but are there kind of any of these areas that are maybe a little bit forgotten? Certainly when you were saying that, what immediately thought in my mind is how people that have real estate or homes, they sometimes can view the economy very differently than folks that are renting, because they, especially in a strong housing market, because they feel like, oh, well, I've got all this, money, this wealth, that's been growing. Um, but are there any like kind of new trends that you're looking at, or uh, thinking that need to be uncovered, even if it's something that was popular before that is maybe coming back to popularity?
Yeah, I think, look, I think AI is a big one. That's the one that everyone is fixated on in terms of the stock market and the economy. I'm really curious to see how the growth in derivatives products evolves in terms of options and futures and leverage products and perpetual futures, right? Like that whole ecosystem just ha- keeps smashing record after record. I believe we're on track for the fourth or fifth consecutive year of records for the US options market. And I think Wall Street is going to keep trying to capitalize on that, keep trying to introduce new products for individual investors. And it's super interesting to see how that involves in terms of risk appetite and just, how it's not really your grandfather's stock market anymore. It's a very, very different stock market than it was in the past.
Hmm.
But also
Well,
sometimes,
oh,
yeah,
go
go
ahead.
ahead.
Mhm. I was just going to say on on the option side, zero DTE seems to be like one of the growing segments there that is really kind of making the
One of the fastest
options.
growing. Yep.
Yeah. But again, it seems like a very all or nothing bet. So, it kind of again comes back to, yes, these products are available, but are they being misused or abused?
They are certainly being misused or abused by some investors. I can tell you that for sure. A lot of people, um, you know, it's incredibly tough to use these products. They require nearly perfect timing. So I can bet that a lot of people are using. I can bet that a lot of people are losing money trading them. It's also interesting because a lot of traders say that they have an impact on how the stock market moves, right? On a technical basis, on a day to day, week to week basis. They say that sometimes derivatives activity has grown so robust that it's actually driving the US stock market. So that's one really interesting trend to watch.
Yeah, certainly on volume, you have to consider that. Again, it's not. I've been watching volume for a while, and sometimes you'll have these rinky-dink companies that skew the volume on one day, or again, there's sometimes these in order to uh, do the arbitrage and everything like that, or you're someone's buying a lot of cues, and of course that trickles down to all of the companies that those Nasdaq 100 stocks. So yeah, are there any other things on the market mechanics side that you think are very impactful in terms of the way it's changing the landscape?
That's really the big one that I'm watching.
No, that makes sense. I mean, that's big. That's big enough.
Yeah. And
You can
growing.
mic
It's
drop right
growing.
there.
Yeah.
So, well, Gunjan, it was really a pleasure having you on the show. I again really appreciate your writing. So for folks that aren't familiar with your stuff, of course, at the Wall Street Journal, you have a lot of content available there. You've been doing videos. I think I've seen some of your vertical videos pop up
Oh.
on my feeds every now and then. Where else can people, follow you and kind of learn more about what you're researching and what you're writing on?
Oh, thank you for that, Justin. I am on Instagram at Gunjan SB GUNJANSB.
Hmm. Wonderful. And again, I really appreciate you coming on the show, and I can't wait to read your next uh, gem of the market. So really appreciate it.
Thank you. Thank you for making this so fun. I really enjoyed the chat.
Okay, great. We'll see you soon. Okay, that's going to wrap it up for us this week. Thank you so much for watching, everyone. And I guess this is going to be dropping right ahead of the Christmas holiday. So have a Merry Christmas, everyone, and enjoy the holiday. We will be back next week with David Saito Chung, an IBD favorite. He is our deputy markets editor. So hope you tune in for that, and hope you all have a great and safe holiday. Take care, everybody. We'll see you next time.